All right, it's showtime. Hi, folks. I have two questions for you. The first is how many of you are sure that you either are or will be paying the least amount of taxes when you're in retirement? And two, how many of you would feel more secure in retirement if you knew that you were paying the least amount of taxes that you could? Well, if you're like most people, you probably answered no to the first question and yes to the second one. And you probably are concerned about whether you will have enough money in retirement anyway. And certainly do not want to be paying the government any more than you absolutely have to. Who would want to do that? So, if that's you, then you're really going to have a good time and really going to enjoy this webinar today. Also, I truly commend you for taking this precious time out of your busy schedule to learn about this really important topic. As you know, our topic for this webinar today is taxes in retirement. And I couldn't be more excited about finally discussing this topic with you guys because I've been incubating on it for over 4 years now, and we're finally going to do it today, right, Rach? With that said, I'm your host, Brian Dougherty from PLC Financial Solutions, located in the Fort Washington, PA area, along with my beautiful, wonderful partner in business and life, Rachel Dougherty. Say hi, Rachel.
Hey, everybody.
Rachel's going to be the moderator for it as usual, and she'll be handling the chat and Q&A boxes at the bottom of your screen. But before we get started, let's take care of some general housekeeping as usual as well. If the screen is not big enough for you to read, you can click on the view options drop down at the top right of your screen to make it larger. Also, you'll see that there are two boxes at the bottom of your screen. One called chat, and it's for your comments, and the other is called Q&A, and it's for your questions. Please use them accordingly, and Rachel will respond to them in kind. Next, I'm sure that many of you guys are going to have questions about the material as we go along. However, since we have a good bit to cover and only an hour to cover it, I'm going to ask you to put those comments and questions in those boxes below, or you can even email them to us at info@plcfs.com if it's easier for you, because at the end, we'll be staying for some extra time to cover as many of them as possible. However, if we don't cover yours, we'll be happy to answer it by either email or even a 15-minute Q&A phone call scheduled for another time. Rachel will be posting a link for you to be able to schedule that at the end of the webinar. Next thing, this webinar is being recorded and it will be sent to everyone who is attending today. So don't worry about missing anything. You'll have plenty of time to check it out again at your convenience. Also, because we want to make sure that you're all paying attention, and because we also want to make sure that you're having some fun as well, before we answer any questions, we're going to have a 6-question quiz for you at the end. And the first person to answer each question correctly inside the comment box will win a $10 gift card to the store of their choice for each question they get right. So make sure you have that notebook, that handy dandy notebook, to jot down some brief notes related to some of the special bullet points that I will point out as we go along. Finally, it's my obligation as a financial advisor and a fiduciary to inform you of our RIA's disclaimer statement, which is that our investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor, and will only transact business in states where we are properly registered or are excluded or exempted from registration requirements. Also, SEC registration is not an endorsement of our firm by the commission and does not mean that our advisors have attained a specific level of skill or ability. And most importantly, all investment strategies have potential for profit or loss. So now that we got that over with, I have one for you as usual. You're going to love this one, Rach. What do you call it when someone's coffee is stolen? A mugging. Where'd I get that one, Rach? Hey, look, if they didn't like that, that was Rachel's joke. I stole it from her. It's on you, Rach. We're probably both going to have to keep our day jobs now, right? No comedian nightlife for us. All right, let's get started. Oh, second, we have here's our mandatory disclosure for this particular workshop. Keep in mind, I am a financial advisor, not a CPA, enrolled agent, or attorney. So the contents of this presentation are based on things that I see day to day in my practice and not specific advice for your situation. That said, many decisions that you make when it comes to your taxes will have tax implications related to them. Some, whether you use whether you use a tax professional or not, to look forward at those implications is another story. But we at least want to show you how it's possible to do that in this workshop. Our goal is for you to leave here with a better understanding of how taxes are different in retirement, so you can avoid some of the very common tax pitfalls that some people make if you can. So these are the things that we will touch on today. As we go along, we'll discuss our current tax system overall and how the rules have recently changed with it. You'll definitely want to know about these things so that you can see how smart decisions when it comes to them can have a significant impact on your tax bill. Also, we'll be discussing how the different income types interact between each other and can have a massive impact on the amount of taxes that you pay. Then, finally, we'll discuss some of the things that you can plan for in order to reduce your taxes. One note before we get started, though, we'll be focusing on married filing jointly statistics, because that's our most common attendees for these types of webinars. But for other filing statuses, such as single or head of household, all the principles remain the same, just different numbers. All right, folks, let's talk about the current tax rules for ordinary income. Our tax system is what's known as a bullet point one. I snuck it in quick, Rach. Our tax system's what is known as a progressive or marginal system. Remember, bullet point one, our tax system is what's known as a progressive or marginal system, which means that as your income increases, the rate you pay also goes up. The most recent brackets instituted under the Tax Cuts and Jobs Act, which was just in 2018, actually lowered the rates of each bracket at each step, which is why many people have paid less in taxes in recent years. This tax chart you're looking at here is specifically for ordinary income as it relates to folks who are married and filing jointly. Bullet point two, but we're now already. Bullet point two. So what kind of income qualifies as ordinary income? Let's talk about that. Well, it's income like wages, most IRA withdrawals, pension income, rental income, and interest from savings and investments. With that said, you must know that there are multiple types of income sources in the eyes of the IRS, and they are not all taxed at the same rates that ordinary income is. And thus, you have your, and thus they have their own charts just like this, which I'm going to show you soon. But first, let's look more deeply at how ordinary income works. Okay, so this chart here might actually be an easier way to visualize the tax brackets for ordinary income. And it's called a tax map because it illustrates the rates at which each additional dollar of ordinary income would be taxed. In retirement, two of the most common sources of ordinary income are pension income and withdrawals from your IRA accounts. Notice here, though, from zero to about $30,700, there's actually no tax right here. There's actually no tax. Oh, come on. Moved on me. And that's due to the new larger standard deduction and additional $1,500 each for a couple over age 65, which we'll discuss more in a few slides. Now, as you can see here, income levels between $30,700 and $52,700 fall into the 10% bracket, which means that only the income that falls in that range gets taxed at 10%. For the income that falls between about $53,000 and $120,000, that's right here where this second green arrow is, that's taxed at 12%. If those ranges look odd to you, it's because we've included the new standard deduction for married couples, which we'll discuss more in a little bit, like I mentioned. The ranges of income seems odd when you look at it when you add that standard deduction. Now, there are really three main spots on this map worth paying a little more attention to because of the bigger jumps that they make in the tax rate. And that's where these green arrows are. The first is where it jumps from 0 to 10%. And the second is where it jumps from 12% to 22%. That's a nice jump. Another 10% jump. And the third is where it jumps from 24% to 32%. Only 8%, but still a nice jump. They are the main areas where financial advisors like myself pay particular attention because it's when clients have income levels in and around those areas where some of the biggest tax planning opportunities lie. So that's why you may sometimes hear financial professionals talk about maximizing the tax bracket. What they mean is that it's good, when possible, to get the most income you can out of your accounts that incur taxes at a current tax rate or bracket before it moves up to the next bracket and starts getting taxed at a higher rate. A good example of this would be for folks who are under the current age of 72 because at that age, that's when the government starts to require that anyone who has money saved in qualified retirement accounts, it's actually moving up to 73, like IRAs or 401ks, they're required then to start withdrawing it in amounts that they dictate. These amounts that they dictate might cause some people to move up to these higher tax brackets. So some people who know that this is coming will sometimes start to withdraw from their qualified retirement accounts several years beforehand. And they may do this right up to the edge of where the brackets start to go up. For some people, if they only needed, say, $60,000 in income from their account each year, they may may choose to withdraw 40,000 extra at that 12% bracket until they reached age 72. This way, the total amount that is left in their retirement account is so much lower that the amount that is required by the government will be a lot lower to withdraw. And it's a lot less likely to cause them to fall into higher tax brackets. Plus, they may even choose to put that extra 40,000 a year into, say, a Roth IRA. And that's referred to as a Roth conversion. Okay, I think that you have a better understanding of how the ordinary income brackets work. Now let's talk about some of the other types of income that are taxed differently, taxed different than ordinary income. Now, let's look at both. Bullet point 3. I stuck that one in. Bullet point 3. Get the notebooks out. Capital gains. Let's look at both capital gains. The bullet point here is about capital gains more than anything. And capital gains are what's generated from gains that are on the sale of any type of assets or property that one can own and make money from. And then also qualified dividends, which is income paid to someone from shares of a certain types of companies that they must own for a certain period of time. We're going to focus on them, but our bullet point 3 is about capital gains. What is it? And it's what's generated from gains that are made on the sale of any type of assets or property that one can own and make money from. Now, you'll soon see that these types of income have their own chart and brackets that are separate from the ordinary income chart and brackets that we just looked at. You'll also see that this type of income is taxed lower than ordinary income is. And that's because our government's public policy goal is to encourage people to invest in companies that are in our country and that contribute to our economy. Also, capital gains and dividend income are still taxed using a marginal tax concept in the same way that ordinary income is, even though the brackets for them are considerably different. Finally, prior to the Tax Cuts and Job Act of 2018, the capital gains and qualified dividend brackets were linked to the ordinary income brackets, but they aren't anymore. Okay, now let's take a look at those brackets. As you can see, long-term capital gains and qualified dividends that would usually fall into the 10% or 12% ordinary income brackets, if they were considered ordinary income, actually come through at 0% tax. I like that, 0% tax, awesome, right? So they are much more generous with the capital gains brackets. So now that you can see why some people might be motivated to want to generate more income from this type of income source. You can certainly see that here. You can also see that most people will earn capital gains income will be in the 15% bracket because of the income range being so wide, since it runs from $89,251 to $553,850. Also, it's worth noting that the 20% capital gains rate applies to income levels that are right around where the old 39.6% ordinary income bracket would have begun, which means that the new tax bill that lowered the rates for ordinary income didn't dramatically change capital gains opportunities for high income earners. Okay. So here's a tax map that applies to only capital gains and qualified dividends, meaning that if you had only dividends and capital gains on your tax return, you didn't make any other types of income. Bullet point 4. I stuck that in good, didn't I? Put it right in the middle of the sentence, right in the middle. Bullet point 4. When it comes to capital gains, you would start paying capital gains tax and qualified dividend tax at the 15 and 20% rates, respectively. Remember, that's the capital gains and qualified dividend rates. There's only 2 of them. Well, three if you count 0, but 2 of them, 15 and 20. As you can see, you would pay 0 tax until you got to $89,251 in capital gains income. So if you only made capital gains income, no other kind, you would have 0 tax up to $89,251, almost $90,000 in income. However, what most people don't understand is that how much you pay in capital gains tax isn't based solely on your capital gains income. That's the trick. Instead, it is based on your overall taxable income, which could possibly include both ordinary and Social Security income as well, which is, as you'll soon see, taxed even differently than both ordinary income and capital gains income, or at least it's considered before they figure it out how it's how much of it you're going to get taxed is. Anyway, I'm getting ahead of myself. All right, so what I mean by that is that it is the combination of capital gains, ordinary income, and Social Security income all together that can cause capital gains taxation at the 15% threshold to begin much sooner than you would think from just looking at this chart. Also, again, as a note, this structure for capital gains and dividends really didn't change under the Tax Cuts and Jobs Act that was passed in 2018, except for the fact that the new larger standard deduction has changed the total taxable income range in a way that has helped most people to not start incurring capital gains tax until their taxable income is higher than it was. Now, let's take a closer look at how these different types of incomes can affect how much is paid out in taxes overall. So here's a couple of examples of how to show you how both the standard deduction and combination of these classifications of income can affect your taxes on each. For the first example, to the far left, is a situation where a married couple filing jointly, who are both 65 or older, who have $100,000 of capital gains on their return with no other types of income. This one is pretty cut and dry because they would end up paying 0 federal income tax because they never reached the 15% capital gains tax, even though they had $100,000 in income. Now, even though the 15% capital gains tax starts at $89,251 of income, what most people don't realize is that the real threshold before the 15% tax starts is $119,950. And that's because the standard deduction for a couple 65 and older that's filing jointly added up to $30,700, which gets added to the capital gains threshold of $89,250. And they total at $119,950. Of course, that threshold is lower for anyone who files either single or head of household. Okay, so let's look at the middle scenario here. In this situation, they take a $30,700 IRA withdrawal in addition to the $100,000 of capital gains that they incur. The IRA withdrawal would come through at 0% because it was wiped out by the standard deduction, which is also $30,700. But it would cause $10,500 of the capital gains income to be pushed over the $119,950 capital gains threshold, which would then cause them to have to pay 15% capital gains rate on that $10,750 that crossed over the threshold. So they'd end up paying about $1,612.50 in taxes because of that. Finally, in the scenario furthest to the right, they take a $50,000 IRA withdrawal this time. Just like the last scenario, $30,700 of it would still be tax-free because of the standard deduction, but $19,300 of it would now incur ordinary income tax at the 10% rate. Plus, this additional IRA income would also now cause $30,050 of capital gains income to be taxed at the 15% tax rate because their overall income now exceeds the capital gains zero threshold of $119,950 by $19,300 more than it did in the first scenario, which was only $10,750. This will now cause the overall tax bill to go up to $6,437.50 when compared to the $1,612.50 it was in the second scenario. So with that, you can now see how additional IRA withdrawals can not only increase your ordinary income taxes, but they can also increase your capital gains tax as well. All right. Now that we discussed the basics of what the income rules are, how they've changed since the most recent Tax Act was passed, and how both ordinary and capital gains income can affect each other when it comes to the taxes, now let's talk more about how Social Security income is taxed and how it plays into all of this. All right, I got to switch waters. Man, motor in here. All right. So with that said, one of the biggest examples of the counterintuitiveness or counterintuitive nature of how minimum distributions interact with capital gains to create ordinary income is through the taxation of Social Security. If all you had on your tax return was Social Security, you would pay no federal income tax at all. But when you have other types of income, it can cause your Social Security to become taxable. It's common among advisors to say 85% of Social Security benefits are for most people taxable. And it's true that for high income people, 85% of their benefits are usually taxable and 50% are tax-free. However, for middle and upper middle income folks, that's not always true because it's based on a formula called the provisional income formula that is provided to us by the IRS. And it can impact everyone's taxes differently depending on the makeup of the proportion of your income types. So let's walk through that, what I mean by that. Bullet point 5. Come on, get the notebooks out. Notebooks out. Come on. The provisional income formula works like this. You take half your Social Security benefits and then add 100% of all your other taxable income sources like pensions, rental income, wages from work. Then add to it 100% of all your investment income sources like dividends, realized capital gains, interest from savings and investments, and even non-taxable interest earnings from municipal bonds. Basically, you just take half your Social Security and add all other possible income sources to it. Almost all. I'm going to give you the one secret one later. Anyway, that's bullet point 5. What's the provisional income formula? Okay. Now, the sum of all this is what is referred to as, like I said, the provisional income. So the provisional income formula provides you what they call your provisional income. All right. Let's take a look at how all that works in some real life type scenarios. We're going to look at that soon. But before we do that, let's take a closer look at what the Social Security provisional income thresholds look like and how they work. Look at this. Got these numbers. I already talked about this stuff. I forgot to push the button. All right. Jump to the next one. Okay, so now that you know how to calculate your provisional income, in order to figure out how much your Social Security benefits will be taxable, you then have to apply the threshold calculations that the IRS gives us to find that out. The key here is that only the provisional income that falls over these thresholds creates taxable Social Security. With that said, the best way to demonstrate how this works is by looking at some examples of it. But before we do that, you need to understand what these thresholds are and how they're applied to your provisional income. So on the top slide here, the top example, you can see that there's a black box with only one person in it, which has numbers to the right of it of that person. They are the income thresholds that a single person will first start having 50% of their benefits taxed at ordinary income rates. That amount is $25,000. Then below is the amount of income where it steps up to the 85% of their benefits being taxed. And that starts at 34,000. Or no, ends it. And then you can see, oh Jesus. And you can see the top side of the single person is 34. So with that said, I'm sure that you can understand that the bottom here is for a couple. And their 50% bracket starts at $32,000 of benefits. And then it keeps being taxed at 50% until it reaches $44,000 of income. After the 44,000 is when it jumps up to the 85%. Now, one of the biggest misunderstandings when it comes to this is that many people think that when they cross over the higher thresholds, the higher thresholds, that 85% now is applied to the full amount of their benefits. But that's not actually how it works. How it works is that only 50% of your income that falls between the lower and the higher thresholds is taxed as ordinary income. And then only 35% of the amount that is above the higher threshold is taxed at ordinary income. Then they're added together to come up with the full taxable amount of your Social Security income. And that 50 and 35 add up to 85%. And that's how that works. So let's take a look at an example of that. Okay, before we get into this though, remember our original purpose for looking at how taxation works with Social Security was for us to see how adding it into the mix of other types of income like ordinary income and capital gains and qualified dividends income can cause each of these types of income to be pushed deeper into their respective tax brackets. However, in these examples that we're about to look at, what we're going to see is how those other types of income actually cause your Social Security income to be pushed above the thresholds that we just spoke about. Also, it's worth noting that in these examples, it will only be IRA withdrawals, but it would work the same if it was capital gains, qualified dividends, savings interest, or even non-taxable interest, as well as all the other types of income, taxable income that we mentioned before. Okay, so to do that, we're going to look at two examples, both of which have the same $60,000 of household income. But the proportion of the Social Security income to those other types of incomes, and in this scenario, these scenarios, it's IRA withdrawals, is much different between the two scenarios, because it turns out that the ratio between them can make a huge difference when it comes to how much tax is paid on the same gross amount of income. For example, in this top scenario, there's $20,000 of Social Security income and $40,000 of IRA withdrawals. So to determine the provisional income amount, we take half the Social Security and add it to the IRA withdrawals, which comes to $50,000 of provisional income. Then we apply the first threshold for a married couple, which is $32,000. Since that $50,000 is $18,000 over the $32,000 threshold, that means that 50% or $9,000 of that $18,000 is over the first threshold. That is the taxable amount of your Social Security, and that's what will count towards ordinary income rates. Now, when it comes to the second threshold, which is $44,000, I'm rolling this back. I jumped into the next scenario. That $50,000 is $6,000 over that threshold. And since 85 cents of every dollar becomes taxable here, that creates an additional $2,100 of taxable income. We already picked up the first 50 cents of each dollar in step one, which is why we only multiplied by 0.35 here. In other words, even though we have 60,000 of household income, at the end of the day, only 55% of the Social Security benefit is taxable. Now let's look at the lower scenario. It still has 60,000 of household income, but this time it's made up of $40,000 of Social Security income and $20,000 of IRA withdrawals. Again, we take half the Social Security and add it to the full IRA withdrawals to get a provisional income of $40,000. This time it's $10,000 less the provisional income. But this time it's only $8,000 over the first threshold of $32,000. Since only 50% of it's taxable, that makes only $4,000 of the Social Security benefits in this second scenario taxable income. and it is below the second threshold of $44,000. This means that that $36,000 of the total $40,000 is tax-free, and that only 10% of the Social Security benefit, $4,000, in this scenario is taxable. That's a huge difference. As you can see, the higher proportion of Social Security income to all other income will create a much lower taxable income. Bullet point 6. Oh, wait a second. This must be a bonus bullet point. Yeah, no, drop that bullet point. I wrote that one. I was going to go with that one, but I'm not. So I'm going to say what it was anyway, but it's not a bullet point. Not a bullet point. As a side note to this, though, the only type of income that can be had that can be in a higher proportion to Social Security is any type of income that comes from Roth retirement accounts. Only they can be in higher proportion than the Social Security and still come out paying the same amount of taxes as this, the $4,000. And if it was that scenario, if it was a Roth IRA withdrawal instead of a traditional IRA withdrawal. Okay, now let's tie all this up in what as far as what would be on a tax return. Okay, when we bring those numbers onto a tax return, we see it a bit more clearly. The $40,000 IRA, and it's traditional IRA, not Roth, $20,000 Social Security results in $2,040 of federal income tax. When the $20,000 IRA withdrawal and the $40,000 Social Security income actually creates no federal income tax at all. That would be nice, wouldn't it? Love it. I want our column to the right all day long, every day. Okay, one last thing to wrap this all up. When it comes to the different kinds of income being blended together, our taxable Social Security income becomes part of our ordinary income. So taxable Social Security becomes ordinary income. And our total ordinary income amount is then added to our capital gains and qualified dividend income when it comes to determining what capital gains bracket and rate our overall income will fall in with capital gains. So it's very important when we go to draw money from any of our income sources that we do it with a consciousness of how they are all related to each other. Okay, now that we discussed how the different income sources are determined and related to each other from a taxation point of view, and how the rules for some of them have changed and others not so much based on the last tax bill in 2018, now let's switch gears a little and discuss some of the more common ways that the IRS has provided us to reduce our taxes and how some of the rules have changed for them as well. So now let's talk more about the various ways that our government gives us to lower our taxes, which is primarily through what are called, now here it is, bullet point 6. Bullet point 6, it's really here this time. Write this down. The two major ways that the government gives us, the two primary ways to reduce our taxes, is through tax deductions and tax credits, which are available to all of us. They've been created mainly to help us reduce our net federal tax bill, but there are actually some that our states provide as well to lower our income taxes as well, but not nearly as many as there are at the federal level. So now these are really a big deal because they can effectively make the first several thousands or even tens of thousands of dollars that we bring into our households tax-free. So when it comes to deductions, what you really need to know is that they are essentially just reductions of our income for certain things that we spend money on. You can either track those things such as mortgage interest, investment interest, local and real estate taxes, gifts to charities, certain types of medical expenses, etc. And then complete what's called a Schedule A and submit that with your annual 1040 tax return. Or if you don't have enough of those types of write-offs, then you just opt to just claim the standard deduction instead. For most people who used to file a Schedule A form, which is also known as itemizing, before the last bill in 2018, most people used to itemize. But now the standard deduction was increased so dramatically by it that now the opposite is actually true. In fact, in 2017, the standard deduction was only $13,000 for a married filing jointly couple. But now it's up to $27,700 as of 2023, which is more than double what it was then. As a result of this, only about 15% of the US population are itemizing their tax deductions at the moment. This is a big deal for retired taxpayers because before this increase in the standard deduction, many of them did not have enough deductions to warrant itemizing on the Schedule A form on their return, meaning that most of them didn't even have the 13,000 worth of deductions, and now they're able to reduce their taxable income by at least $27,700. Or even $30,700 if they're over 65. That's a massive difference. To explain that a little more, the age 65 plus deduction is for both people that reach age 65 or people who are actually blind. And the US government now gives everyone that qualifies at that age or is disabled by way of being blind, $1,500 deduction for a married couple and $1,850 for a single person. Also, this provision is not new. It was retained in the new tax law and increased only $100 in 2022 to the present, actually. All right. So now let's talk about the tax credits that our government gives us to lower our taxes and to incentivize us to do certain things that it views as healthy for us and our country. So now we talked about the tax deductions. Let's talk about the tax credits. The biggest difference between a tax credit and a tax deduction is that a tax credit can actually be used to directly reduce our tax bill, where a tax deduction can only be used to lower the amount of taxable income that is used to determine what our tax bill is going to be. So it's also worth mentioning that many tax credits are specifically designed to incentivize behavior that our government encourages us to engage in. Things like paying for our own health insurance, working at a job, going to school to better educate ourselves, saving for retirement, and even building a family by having children. And there are actually many more that have been created for many other specific reasons. Some are for individuals or families like the ones I just mentioned, but others are for businesses and other things like disaster relief and charities and things like that. The list really goes on and on. With that said, the two most commonly claimed tax credits today are the healthcare tax credit, which is given to people who pay for their own health insurance, and the earned income tax credit, which is for people who work low to moderate paying jobs that earn between $0 and $63,698 in 2023. They're also probably the most popular as well because they are both what they call refundable credits, which means, like I mentioned in the prior slide, that even if we did not owe or pay any taxes, if we're eligible for these credits, the IRS will actually send us a check for the amount of whatever the credit's value is. So we get paid for these credits regardless of whether we pay taxes or not. I'm sure you understand now why so many people like these so much. Also, a less common tax credit, but one that may be accessed by some people who take a part-time job in retirement, is called the Savers Credit, which basically incentivizes lower income people to save in retirement accounts. So even if you've been a higher earner all your life, your tax return will be set up to present you as a lower earner between the point of a formal retirement and the time you're forced to begin taking required minimum distributions, or them RMDs, from your retirement accounts. So, just going to put them all up because I keep forgetting to hit the button. There are just some of those tax credits. So it's possible for us to directly reduce our taxes owed just because we like to save our money. That's pretty cool, right? If that is a motivation to save, then I'm really not sure what is. Now, let's look at an example of how these deductions and credits can really help in some situations. This example is of a couple that took $40,000 of gross income, all of which was classified as ordinary income, and had at least $2,000 of income in the form of wages from a job. First, the income is reduced by the married filing jointly standard deduction. Then it is reduced again by the addition of the age 65 deduction. Then its last deduction is a $2,000 IRA contribution deduction. Finally, all this leads to a taxable income of $7,300. So you see how the deductions reduce the income? It didn't take you down to no taxes though, right? So at this point, our taxable income is then multiplied by whatever our tax rate is, which then determines what amount we owe for our taxes, which in this case is $730 because it's at the 10% rate. So as you can see, the deductions serve to reduce our taxable income directly and considerably, but they did nothing to actually reduce our tax bill directly. This is where tax credits come into play and are so really valuable, because when it comes to tax credits, they are different than deductions and exemptions in that they directly reduce our tax bill. In this case, the Savers Credit results in $1,000 tax credit and then reduces our total federal tax bill to zero. Now, you might be asking yourself, why only zero? This is because the Savers tax credit is a non-refundable tax credit. So it can only reduce your taxes that are owed down to zero. However, if it were a refundable tax credit, then the IRS would have actually paid out a $270 tax refund in that situation. Okay, so I think that it's worth reiterating one last time before we move on from our discussion on tax deductions and credits. When it comes to the current standard deduction today, do you remember how this tax map I showed you earlier Just to make this abundantly clear, there are no taxes that are due for all people that are married and filing jointly on the first $30,700 of income that they claimed on their tax return. This is the impact that the new standard deduction and additional age 65 and sight impaired deductions have had on our current tax liabilities. Prior to this, it was only $13,000 for the same situation. So we should never take our tax laws lightly, because that is a massive impact. With that said, now let's turn our attention to some of the other major factors that can have a great deal of impact on our taxes in retirement. Kind of run quickly through these. We talked about require minimum distribution. Now, realistically, if that were all that was if this were all that was our tax system, it would be relatively intuitive. But unfortunately, in retirement, we can see several complicated factors. Each of the factors that you see on this slide creates an environment where what you expect to pay in taxes may not be what you end up actually paying. We'll dig into each section. The first complicating factor is required minimum distributions, also known to most people as RMDs. Most of our clients have saved pretty significantly into 401ks or IRAs plans over the years. Generally, these contributions were pre-tax on the front end, so all withdrawals come out as ordinary income. Once you reach a certain age based on when you were born, you're forced to begin taking withdrawals. That age varies based on when you were born. It used to be age 70 and a half, but then it became 72. But for people who are reaching RMD age now, it's 73 if you were born prior to 1960, and 75 if you were born in 1960 or later. The process for calculating these withdrawals is relatively straightforward. Each year, you take the ending balance of all your retirement accounts combined for the prior year, and then divide it by a factor that the IRS gives us that represents your remaining life expectancy. Here's an example. Start age 73, divide the prior year's ending balance by the remaining life expectancy. What that means is, to them, you got 26.5 years left to live. Divide the balance that you had from the year before, and it comes to $18,868. That's what your RMD, or required minimum with distribution, will need to be for that first year. Okay, this is the chart that the IRS gives us with the life expectancy factors on it that are used each year after you're required to start withdrawing from your retirement account. Notice that each year you age, your life expectancy goes down by less than 1 year, such that the tax runs all the way out to age 120. And even at age 120, you only have to take out half of the prior year's ending balance. No big deal, right? The key here is that if you've done a good job saving into your IRA, your minimum distributions plus your Social Security may be more than you actually need to sustain your lifestyle, the lifestyle that you want to live. If that's the case, it's likely that you'll be paying more taxes on the back end than you could be, as you'll see in the next few slides. So when you think of capital gains, if you're like many people, you think 15% tax. Only when I sell something that appreciated. Not really something to be that concerned about, right? What many don't realize is that you can recognize capital gains even without selling anything, particularly if you own mutual funds. This is called a phantom gain. The best way to illustrate this is an example to say in a mutual fund, they say in one of the mutual funds you own, they bought Apple stock in 1985. You bought the mutual fund in 2019 and held it all the way through 2023. In the middle of 2023, the fund manager decides that Apple isn't a good investment value anymore and sells the entire position. Any gain that was recognized on that sale must be passed through the mutual fund to the current shareholders, even if they didn't participate in any of the gain of the underlying stock. The important thing to remember about capital gains is that if you have invested non-qualified money, even if you're generally a buy and hold type investor, it is likely you will recognize at least some capital gains in some years. More importantly, when you experience a capital gain on your return, it can have a greater impact than just the tax on the gain because it increases your adjustable gross income and may cause other deductions to be phased out. For instance, right now, as things stand, anyone who contributes to a company-sponsored retirement plan and an IRA as well can still fully deduct those IRA contributions until their modified adjustable gross income reaches between $116,000 and $136,000 for a married couple filing jointly. This means that when these income thresholds are met, that their IRA contribution deduction is gradually phased out to zero at the highest range. So as you can see, if a couple that is on the cusp of these income ranges has even a small capital gain occurrence, it could trigger a loss of a valuable IRA deduction. And that's why it's good for you to know that it's possible and that it could affect, your taxes in some ways that you weren't aware of actually initially. So now we've covered the most common ways that create both confusion and opportunity around taxes and retirement. These last few things are things that impact higher income people primarily. Both could impact you in a year that you actually do a Roth conversion or have a larger than usual purchase, which causes you to make a larger than usual withdrawal from either a taxable or tax deferred account. Medicare is now means tested, and these thresholds include your full Social Security benefit. If you fall over the threshold, you end up paying an extra Medicare Part B and Part D premium. Rachel knows all about this, don't you, Rachel? She deals with it every day. In the scope of your total tax bill, it's probably not much, but it's not insignificant either. These premiums are based on your income from 2 years ago, too. So it's worth paying attention to the thresholds as you consider how much you take from various accounts. Again, this is just another potential hidden tax that many people are not aware of. Also, there's a 3.8% net investment income tax also that impacts higher income taxpayers. It creates an additional 3.8% tax on net investment income, which includes capital gains and dividends, interest and annuity payments, passive business income, and rents. Basically, if it's not derived from work or a return of your own capital, and it's over $200,000 limit for a single person and $250 limit for someone who's married, adjustable gross income threshold, it's likely to be subject to an extra 3.8% additional tax. Of course, this won't apply to most people, but it's worth mentioning just in case it does for anybody on this webinar today or anybody that you're close to. Okay, the final example of potential tax pitfalls we're going to give applies only to people who have higher incomes and a lot of deductions. It's called the alternative minimum tax, or AMT for short. And it's a flat tax system that runs parallel to our normal tax system. Prior to the most recent tax reform, it was estimated that fewer than 4 million taxpayers nationally were actually subject to it. But tax reform significantly actually increased the thresholds and phase outs related to the AMT. So it actually applies to even fewer retired taxpayers now. However, if you're likely to be the subject of it, and odds are you would know if you were, this is definitely an area that you'd want to be working with a good CPA who understands this type of tax situation better than yourself. Also, so since you now have a pretty good understanding of the different income types and how they can affect each other, and the different ways that the government gives us to reduce our taxes, and several of the most common and uncommon factors that can affect our taxes due, let's now have a brief recap of some of these things, and then go through a case study that will demonstrate the impact of indiscriminate spending in both taxable and retirement accounts. Wow, we are rocking and rolling here. All right. One of the biggest reasons that we all need to have at least a good general understanding of the things that we have covered so far is that in the past, when the government has needed new tax revenues, the method has usually not been to change rates or brackets evenly across all taxpayers. Instead, it's been to introduce phase outs of deductions and exemptions, or begin to include income that was previously not taxable, like Social Security benefits. The result is a tax system in which the most important number isn't necessarily the tax bracket you landed, but instead is the effective marginal rate / bracket that your last dollar falls into. In other words, how much of your last dollar did you actually lose to federal income tax? First, let's revisit the tax map. Remember, as you increase ordinary income from left to right across the bottom, you can see that the rate should intuitively be applied to the next dollar. That's what you think, right? That's what it looks like when you look at this. The same principle applies when it comes to capital gains and dividends. However, when the different income types are blended together, the tax rate that you will pay for every additional dollar spent becomes a lot less intuitive and, frankly, a lot more complicated. So much so that it usually takes a computer software program to figure it out. But it's definitely worth knowing. Let's take a look at a quick case study here to illustrate the idea of effective marginal rates and how they work. We have John and Jane. They're married, filing jointly, and both over 65. They have $64,000 of combined Social Security income, $10,000 of long-term capital gains this year, and $53,000 in IRA withdrawals. This was a little bit hard to see. I did trying to fit everything in here, but I'm going to talk it out. So here's their tax map. Now you can see right here, it's about at around $14,000 of ordinary income from the IRA accounts. The first dollar after that starts to become taxable. So to clarify how this works on this tax map, it only shows us the amount of ordinary income that they're at when they incur the various effective marginal tax rates moving from left to right. So you see them? The effective 18.5, 22.2, 49.9, they're effective marginal tax rates. They're not actually, they're not tax brackets. They're the actual tax rate that the person is paying. So it does not show us on this map the effective tax rates of Social Security and capital gains income, which combine, which they have inside it combined. But it does factor them all in together as they're realized, and that's how these effective marginal tax rates, moving from left to right, are computed within the program. The result of those computations is the reason why their actual ordinary income, which is represented by the gray area on this map, starts to be taxed at the $14 and $1,000 point on the map and reaches the 18.5% effective marginal rate as quickly as at $14,800 and stays at that rate till it gets to $26,000. It's also because it's at that $14,000 point where the combination of that much ordinary income and capital gains starts to drag enough Social Security into the calculation to begin making every additional dollar withdrawn from their IRAs taxable at 10% to quickly, and then it quickly reaches the point of at $14,800 where 85 cents of each dollar of Social Security starts to be taxable as well. And thus quickly reaches the effective marginal rate of 18.5%. As a result, you can see that this couple barely experienced the 10% or the 12% bracket and ends up where the green dot is here, which is only $7,000 away from hitting that monster rate of 49.9%. However, they do ultimately end up in the 22.2% effective marginal tax bracket, where the majority of their dollars are claimed. With that said, I'm sure that quite a few of you guys are wondering how it's possible for someone to actually pay 49.9% rate on any part of their taxes. Let's look at that. So, if you're saying to yourself, wow, wait a minute, that spike actually occurred at the 12% bracket. How can that happen? Believe me, you're not alone. Intuitively, this is a couple in the 12% bracket for ordinary income. But you'd expect if they did have, say, $1,000 of ordinary income that went just into that 49.9% area, inside that 12% bracket, for it to only create 12% tax, which is only $120. But here's what actually happens. That $1,000 withdrawal gets taxed at 12%. So it does incur $120. But then it caused $850 of Social Security benefits to become taxable, which adds another $102 to the tax bill, which then causes another $1,850 of capital gains that would have come through at zero to become taxable at 15%, which results in another $277.50 of federal income tax. In short, that extra $1,000 IRA withdrawal ends up costing a total of $499.50 in additional taxes due, which amounts to 49.95% effective marginal rate on that small part of the income. This is why it's always good to do some tax research before you make any one-time withdrawals from your different retirement and taxable accounts. Also, folks, these same principles apply when it comes to capital gains on your investments as well. That same couple were considering whether or not to sell a stock that had a $25,000 gain on it this year. Don't you think that they would want to know if they were going to lose a larger portion of that gain than they thought in federal income tax? With that knowledge, they may decide that it makes more sense to only sell part of that stock position this year and another part next year in order to avoid crossing over an effective marginal tax rate threshold, and or even moving into the next ordinary income tax bracket as well. Again, folks, I'd like to reiterate that you should always do your homework when it comes to potential tax spikes that you could incur when you are withdrawing from any types of retirement and taxable investment accounts. On top of that, I highly recommend that you give deep consideration from a taxation point of view to when you start taking any type of retirement income sources like Social Security, pensions, and annuity lifetime income payments, because they too may cause major spikes in your taxes that you may have been able to avoid if you time them differently. Okay, folks, I'd be remiss if I did not discuss how a Roth retirement account can play a pivotal role in providing your taxes, improving your taxes in retirement. First, just in case there's anyone out there who does not know how a Roth account works, let's discuss that quickly. A Roth account is a type of retirement account that allows you to save a certain amount of post-tax income every year, where the growth on it is tax deferred, just like it is in a pre-tax retirement account like an IRA, 401k, 403b, etc. In fact, just about every type of pre-tax retirement account that exists today also exists in a Roth version of it, which means that there are Roth IRAs, Roth 401ks, Roth 403bs, Roth 459bs, oh my goodness, etc. The major differences between these two types of retirement accounts are that the pre-tax version, which are also referred to as the traditional version, is not taxed before it is invested. It is taxed when you are withdrawing it instead. And the post-tax version, which is known as the Roth version, is taxed before you save it, but then not taxed when you withdraw it. It's tax-free at that time. Now, there are several other differences, but for the purpose of this presentation, let's just leave it at that. With that said, you can obviously understand how having a retirement account that grows tax deferred and can be withdrawn tax-free will help you lower your taxes in retirement. The problem is that most of the clients that we have and that we have reviewed over the years either did not have access to a Roth account over the years when they were saving, or were not aware that they did. So most of our clients have most, if not all, of their retirement savings in traditional pre-tax versions of these type of retirement accounts. However, they would love to still be able to take advantage of the tax-free nature of the Roth account. And one of the major ways that can be done is by doing what is known as a Roth conversion periodically in order to withdraw some of their traditional retirement account savings and move it over to the Roth retirement account. With that said, the best way to do that is by finding opportunities when you are planning for your taxes to look for times when you can take advantage of a lower tax bracket by withdrawing extra income right up to the edge of where that next bracket or effective marginal rate begins. In this slide, John and Jane only took $36,800 in IRA withdrawals this year. Which is what left them with exactly $20,000 shy of moving to the next effective marginal tax rate, which is in this case that 49.9% Great. This was a perfect time to be able to remove that extra $20,000 from the traditional IRA to move it into that Roth IRA. This is usually how a Roth conversion opportunity is taken advantage of and executed correctly. So this is one of the first things that should be considered when creating a retirement strategy for a client that is either ready to retire now or is not long away from it. However, what's even better than this, when a client is many years away from retirement and a strategy can be put in place now for them to contribute to both traditional and Roth retirement accounts at the correct proportion to where they can take full advantage of paying less taxes now and less taxes later when they retire. Okay, folks, let's sew things up here. The fact is that there are a lot of ways to control taxes and to plan in advance to create a tax-efficient retirement. The first is to diversify among different account types that have different tax treatment. The second is to use tax-deferred accounts where appropriate. The third is to blend your withdrawals from those different types of accounts and income sources, rather than to simply spend from them in a sequential order. Okay, the final way to help control your taxes is by paying close attention to the different types of investments you hold in these different types of accounts. It too can make a big difference in the tax efficiency of your retirement income. One of the best examples of this is that it usually is better to hold bonds or any type of investments that pay interest or short-term dividends in accounts that are tax deferred, like IRAs or Roth IRAs, instead of taxable accounts like brokerage accounts. And that's because you will be obligated to claim that income from those types of investments as ordinary income on your tax returns every year, regardless of whether you actually withdraw it or not. Okay, folks, that's it for the educational part of our workshop today. Woo-hoo! Rocking and rolling. We actually put in some time on this one. All right. So I hope that you learned a few things about how things are and how they could be when it comes to your taxes and retirement. I also want to thank you and commend you for taking this time from your busy schedule to learn more about this extremely important topic. I truly believe that it will make a huge difference for you and your family when it comes to preserving your wealth if you implement a good tax mitigation strategy with your retirement plan. With that said, if there's anyone attending this workshop that's interested in this type of advanced tax planning, if you schedule a meeting with me within the next 2 weeks, I'd be happy to create a custom tax map and report based on your situation at no charge. All you have to do is click on the 60-minute meeting link that Rachel has posted in the comment box. Did you post it yet? Posting it now? Okay. And you can go directly to my calendar and book a time that is convenient for you to do so. Also, if you have any questions, either in regard to this topic or in general about any other financial matters, I'd be more than happy to discuss them with you as well in a complimentary 15-minute Q&A phone conference. Rachel's also pasting a link for you to book that as well. Also, you can find both these links and all of our contact information at all times on our website at plcfs.com. And you can click on the book now or schedule a meeting or contact us tabs on our navigation or at the top right of any of them, any of our pages on it. All right, so let's start our quiz. You ready for it, Rach? Okay, folks. Got 6 questions here. You're going to put your answers in the comment box. And anybody who gets the first person to get it right is going to win a $10 gift card to the store of your choice for each question. Also, what I want you to do is, if you win, put in that same comment box the store that you would like a gift card from? Generally, we try to get them, we try to send them by email. Okay, first question. What kind of tax system do we have? Remember that? Remember that first?
Oh, it looks like Frank got, oh, no, it was Larry first, Larry Krasley.
Larry, all right, Larry. Good job,
Yeah.
buddy. All right. What did he put?
It got progressive and marginal.
Yes, yes, good one, Larry. Second question. Name one type of ordinary income.
Whoa. That was Bob.
Oh, Bob's back, huh?
Yeah,
What'd he put?
he said wages.
Yes. All right, good job, Bob. Number 3. What kind of gains are generated from the sale of any type of asset or property?
Oh, it was Frank. He got capital gains.
Yeah, good job, Frank. Don't forget to put the store in there. All right, number 4. Name one of the 2 main capital gains rates. One of the 2 capital gains rates.
Bob got 15.
Bob, he's quick to the trigger again, right? All right. Question number 5. What is the name of the formula that takes half of your Social Security and adds it to all your other sources of income? Except for Roth.
All right. Oh, Bob got it again. He said provisional.
Provisional income.
Yep. Bob and Frank are battling it out.
All right. Come on, Larry, you can get in there. All right. Number 6, last one. Name one of the 2 primary ways the government gives us to lower our taxes.
Oh, it looks like that was Frank. He said deductions and credits.
He named both of them. Great job there, Frank. Awesome. That was pretty good, pretty quick. All right. Any questions?
Yep, let's see. See here. There were a few in the Q&A box and a few in the email. So let's go. The one in the Q&A box was, how is the Savers tax credit calculated? And also, how is the healthcare tax credit calculated?
Well, that, Savers tax credit, I believe it's 50%. That's why they got $1,000 off.
Again, I think it's based on, it depends on
You get
how you contributed
2,000, but they'll
to.
give you up to 50%.
Right. Okay, is that the same for the healthcare tax credit?
The healthcare tax credit's a lot different. You get that 1095. Yeah, that has to be done by your accountant.
Right, because it's an individual.
Yeah, it's an individual thing. They use that 1095 form.
Okay. Right. Yeah. Okay, so in the email, looks like when is the best time to consider Roth conversions?
Oh, okay. Well, I think so. If you were like most people and you saved most of your money into traditional 401ks and IRAs and traditional retirement accounts, it's been my experience that the best time is somewhere from the time when you maybe around anywhere from, depending on the numbers, you'd have to use a calculator. They have Roth conversion calculators. Anywhere between like your early years of retirement, you don't even have to be retired, but you probably want to not be working. So you're not taking your wages in, right? Unless you had you're working like a part-time job or something, it's a serious reduction in your income. So when you stop working from that or lower your income a great deal to the time when your required minimum distributions start, you have that window period of time that it makes usually the most sense to get as much out at the lower bracket as you can during that period of time.
Okay. What does it mean to have an effective marginal tax rate?
That's a good question, because if you look it up, they'll tell you what effective is and they'll tell you what marginal is. So it's actually the average rate that you pay as a result of crossing over into different income brackets of different types of income. So it's kind of a nuance there, but it's basically the average return. And then as you're moving through the different income brackets, you'll create which is an average return.
Okay. One more. Is it always possible to lower someone's taxes by planning in advance?
Yeah, hold on though. On that last one, just for a second, I just want to, say something else on that.
Oh, sorry.
It's not always the bracket. Just like we saw that 49.9% effective rate that happened when the people were still in the 12% bracket. It becomes marginal when you're using different kinds of income that's blended within that same bracket. The average of what falls into those different kinds of income, even though it's still in the bracket. So it's an average effective marginal rate because it's the average of those different marginal systems combined, even though they could be in the bracket, one bracket of ordinary income. I wanted to get that, differentiate that.
Sorry. Do you need me to repeat that other question?
Yeah.
It says, is it always possible to lower someone's taxes by planning in advance?
No, it isn't always, unfortunately. But it depends on how much, where their income sources are coming from. If they can control, if they have enough savings that they're going to draw income from, then it can be. But when it comes to income, if they have a locked-in pension amount, and sometimes you get into a situation where a person, for whatever reason, can't control when they're going to start their Social Security. So they can't, control how much that benefit's going to be. So if they're locked into certain kinds of like pension income and Social Security income, and they're not going to be drawing from retirement accounts, well, then there's not much you can do. But if somebody's going to be drawing from those retirement accounts as part of their income, then it could definitely be done. It can also be done in the other situation. You can plan in advance by maybe doing some conversions or what have you to have some Roth money there for when people are going to have one-time expenses. So they know in advance that they're going to have one-time expenses that could push them up. Then you could do some planning. And even though they might not be drawing from their funds otherwise, and just have Social Security and pension income, but we can plan in advance for times when they know they're going to spend that money, and then you could kind of have some safety tax-free money there. But It's not always 100% that you can plan.
Okay, so we got one more email and one more in the Q&A.
Mhm.
So what do you think is the best approach to reducing someone's taxes in retirement?
Well, the best approach, in my opinion, is when you do it early. To create Roth accounts, taxable accounts, and tax deferred accounts, retirement accounts, and to figure out in advance, to project how much you want to have based on how much money they have to save, and divide them up, those contributions, proportionately to where you would an average return at a later date know you're going to have X amount of taxable income, and then X amount of tax deferred income, and X amount of taxable income. And then, with the standard deductions and all that, you can kind of figure it out. That's the best time in advance, in my opinion.
Okay. And then there's just one last one in the Q&A box, or a couple in the Q&A box, sorry. Are disability wages the same as regular Social Security wages when it comes to the tax brackets?
Social Security disability is. Supplemental security income, that's not taxable. And neither is like welfare benefits or anything like that. But Social Security disability is taxable, or even disability from an insurance policy.
Okay, and then the last one here in the Q&A says, can a withdrawal of qualified money be used for charitable donation with paying tax on the money?
Well, there are special situations you can set up. It depends on how much charitable donations you're going to do. But yeah, you can certainly use a charitable donation to offset income and lower your taxes. And that's a common strategy for people who, give regularly.
Okay, it looks like that's it. Oh, wait, no, sorry. Oh, there's one more for Angie.
What is it?
No, Angie said she just had a message from the last seminar. So I'll get that to you later.
Okay, cool.
Okay.
All right, folks. Please, what I wanted to say too, before we jumped into that, I jumped off it because I don't want to give it away too quick. I was just saying, you can also contact us. You could also call us at 215-804-9708. And, we'd be happy to discuss any of these things. You don't have to book on the links if you don't want to. So, and like I said, you can go onto the website at plcfs.com, and you can get our information at any time. So we're definitely here. All right. With that said, I'm jumping all over the place. If there's anyone attending this workshop, I'm all screwed up here, Rach. I'm losing my. All right. All right. I got to jump. I can't lose my pitch here, Rach, for next month. Please mark your calendars. And we're making a change here. So Bob, anybody who's on like regularly, right? Mark your calendar for Tuesday, June 20th, 2023, right? That's not the last Tuesday of the month. It's the third Tuesday of the month. And we usually do our webinar at 7 p.m., right? But we usually do our webinars on the last Tuesday of the month, but we're not next month because we're going on vacation. We're going to Niagara Falls that week. Aren't you glad I remembered, Rach?
Yes, very glad. You'd be in Niagara Falls sitting in the hotel room by yourself.
Wouldn't be the first time. Well, it would be in Niagara Falls, right? So for myself, Brian Dougherty of PLC Financial Solutions, and my wonderful, beautiful wife, partner in business and life, Rachel Dougherty. Say goodbye, Rachel.
Good night, everybody. Thanks.
We're located in the Fort Washington area, just off the boulevard. I mean, just off the, what am I doing today? I'm going crazy. just off the turnpike. And so everybody have a great rest of your month and absolutely have a great June. And we will see you next month on the 3rd Tuesday, right? Have a great night.
Night, everybody.